Good morning. This is Larry McMillan with a market comment on Monday, September 7th, which is Labor Day. I'm recording this after the overnight Globex session has ended. So, just in case you're wondering, last night the futures dropped about 40 points right away and then rallied back about 60. So they're up 20 net since Friday's close. That's the S&P futures. So last week saw some heavy selling for the first time in a while. And while it did trigger several sell signals, as we were suspecting that it would, it also generated a buy signal. Tops are not generally like upside down V's. They're more of a rounding thing. It takes a little while to build a top. So we're probably in that top building process right now. And we could easily have some volatile action in both directions. The S&P chart has held above some support levels. It closed at 34.25 on Friday, so that's above the 3,400 support level, although it traded below there right down to 33.50. So that's also a support level. And then below that, 32.80. I would think if it closed below 3,400, that's still a negative, and of course, closing below 33.50 would be an even further negative. However, since it hasn't done those things yet, and we see that the futures are up overnight, the chart is still positive. I mean, the 20-day moving average is still rising. It hasn't even closed below the 20-day, or maybe right on it on Friday. And except for that one bout of selling heavy sell programs early Friday afternoon, it really hasn't violated those support areas. So at this point, you still have to give the benefit of the doubt as being bullish on the S&P chart. That is not the case anymore with the equity-only put call ratios. They turned up with a vengeance over the last 2 days as put buying came in at very heavy levels. And so those ratios have swung upwards, and that is a confirmed sell signal from an extremely overbought condition. So this typically would generate some serious downside action. Just recent history was that in January they sort of did the same thing, but the market didn't really break till February, as you'll recall. So they may be a little bit early here, but this is a significant sell signal. The breadth oscillators remain on sell signals as well. Also, the cumulative breadth advanced decline line never did make a new all-time high, so that was a negative divergence. Now that it was in place, if the market came back and went to new highs and that still was not making new highs, that would probably be even more significant. But it was a negative divergence, and as we've said, the purpose of following that is not to sell on the negative divergence, but to act on sell signals when they do occur. So now we're getting those other types of sell signals. This brings us to volatility, which has been pretty crazy. As we mentioned last week, VIX was rising while the market was rising. Then over the last couple of days, VIX fell while the market fell. So we don't usually see these things happening. Usually VIX moves opposite to the market. But obviously there have been some severe distortions in VIX because of, it sounds like it's because of hedging practices by market makers against some very heavy buyers of NASDAQ and FANG stock options. In any case, we do have a VIX spike peak buy signal. It rose far enough and then dropped sharply enough that a spike peak now exists on the VIX chart. In fact, VIX closed more than 7 points below its high on Friday, which is pretty crazy. So that's a short-term buy signal, and it could, we will play that as well. It could work out to be that the short-term buy signal plays out and then the major top forms, sort of like what happened between mid-January and mid-February earlier this year. VIX also closed above its 200-day moving average, though, which is not particularly encouraging. And if the 20-day moving average of VIX also gets up to the and crosses above the 200-day, that's an outright long-term or intermediate-term sell signal. The term structure of the futures, VIX futures, remains distorted. October and November are still very expensive futures. Obviously, they're priced off of post-election SPX options, and that's becoming more and more of a worry. I'm reading a lot of apocalyptic articles I would probably say if I'm reading about it, it's not going to happen. But just in case, the VIX options are and futures are way up there in terms of price. We did do a study that's in our newsletter this week. You may be interested in taking a look at the option strategies to pick up on a study of seasonal patterns during election years in VIX, and we're going to continue that with seasonal patterns in other areas. So just to summarize, we are playing both long and short side signals right now. And I do think that the S&P chart has not broken down yet. And so you're not going to get a severe bearish move until that happens, which would be, let's say, a breakdown below 33.50. I invite you to visit our website, and we all are in 2 weeks having our next Saturday seminar as well. You might be interested in that too. In any case, good luck and good trading. Have a great week.